Asia will be as big as the developed countries as a whole. Basically, there are two groups of winners in the world economy, and I think that explains a lot about our politics today. I've always thought that when my work was referred to as majestic, it was majestic to me means something fairly close to pompous and boring. I hope I will avoid that fate today. So I've been asked to talk about what's going to happen in the 21st century, and I will get to that subject shortly, but I have to be honest and say I don't know what's going to happen in the 21st century, but I do think I know what's been happening in the 20th and very early 21st century, and I think that's where we have to start. I'm to conclude on this, it's a pretty good bet, not certain, that the world economy will grow in the 21st century. It's not certain. There are some fairly big issues which I will touch upon. And it will probably grow reasonably rapidly, but not as quickly as in the second half of and early part of the 21st century. It is very plausible that we've passed the growth climacteric for demographic reasons and because so much or such a big part of the convergence process in Asia has now happened or is now well underway. But that's not certain either. So before I come to that, let me just outline what I want to cover. And before that, I will just have one quotation which I think tells you something incredibly important, which is that we are, and perhaps that's the biggest of my themes, we are now in a different world from the world that most of us, certainly in the West, took for granted after the Second World War. And this is, of course, a quotation from Donald Trump, President of the United States, in his inaugural address in 2016. I don't know why I've got 2018. I apologize for that. Protection will lead to great prosperity and strength. And if there's one real belief that Donald Trump has, it is that globalization has been a trap, a fraud upon the American people. So what we have here is the world's most important country still, the architect of the global economic system, the guarantor of the stability of the West, and of course, in significant ways, this region too, basically saying, we've had enough of all that. We are now somewhere else, and we know now that he meant what he said. So what I'm going to cover in my remarks is three major themes. The first, which I think is probably the most important part, is the secular trends. And I'm going to focus on a few absolutely fundamental secular trends which will shape inevitably our the next century, or certainly the coming decades. Then I'm going to talk about, I think it's crucial, about the financial crisis of a little over 10 years ago and the legacy it has left us. Because the legacy is unbelievably significant. It is still with us. It has shaped the post-crisis legacy, not only the West, but also, as I will argue in detail, it has shaped the Chinese economy over the last decade, and we have not left it behind. And then I will talk about the future in the light of that background before a brief conclusion. So there are four secular trends that I want to stress. I could have done many more. I've done presentations with many more, but these are, I think, the four most important things that are going on. The first, of course, is China's rise as part of the rise of Asia, and for this purpose, I mean East Asia and South Asia. The second point I want to make is who in the great globalization process of the last 4 decades or so, who were the winners and who were the losers. The third thing I want to discuss is the global productivity slowdown. And this raises a fascinating paradox, which is why, when we are so clear about this technological upheavals of our time, why is measured productivity slowing down? I can't discuss that in detail, but the fact is that seems to have happened. It means that at the frontier of the world economy, people are not on average getting better off very quickly. That, combined with what I talk about in the winners and losers, is very significant. And finally, I'm going to touch on climate change. So let me start with the first of these themes, China's rise. So this little chart for 92, 2002, 2012, 2022 from the IMF, it shows shares in world gross domestic product at market prices, and so it's what we are all familiar with. And if you look at this, you've got the US at the bottom, then the European Union, then Japan, and the black is the remaining advanced economy. So back in 92, the developed countries, the familiar developed countries, that's not very long ago, were about 84% of the world economy. There wasn't anybody else that mattered. By 2022, this will be down to under 60%. It'll be about 56%. Now, nobody knows if these numbers are exact, but this is the quickest and biggest shift in the relative economic power of the world's leading economies there has ever been. It's an inverse of what happened in the 19th century, but about 4 times as fast. And of course, the difference has been made up, and this is crucial, entirely by Asia. There is no other emerging region that has expanded in relative size. Those are the 2 blocks at the top. And roughly 70% of the increase is China. So we are seeing here a staggeringly swift, unprecedentedly swift, and profoundly significant transformation of the world economic system. And China's GDP per head is still relatively low by developed country standards. In real terms, it's probably about a quarter, so it has lots of potential. The second thing I wanted to talk about is where the winners and the losers in that period from 1980 to 2016 were. This is from the so-called the World Inequality Report, a very standard source. And if you look across the x-axis, what you're looking at is the percentiles of the global income distribution. So right at the left are the poorest people in the world, right in the right is the 99th percentile. I'm going to come to the 100th in a moment. And basically what it shows you is the biggest proportional increases, is the proportional increase in real incomes from the base, so its percentages were in people in the bottom half, and particularly in the 20th, from the 20th to the 50th percentile of the global income distribution, and that was basically East and South Asia, which is roughly half the world. And the rest of the world, most of it, and that's basically the middle income and lower income groups and upper middle incomes of the developed world, and also crucially the former Soviet Union and South America. They've had very, very modest increases in real incomes, relatively speaking. And then finally, we get to the very top of the income distribution of the world. This is the top percentile, and this is broken down into ever tinier subgroups of the top percentile. And you look at the left-hand side, they've done great. So basically, there are two groups of winners in the world economy, and I think that explains a lot about our politics today, namely the bottom half of the world, particularly not the very poorest of the world, not the bottom 10%, but the above all, the populations, a huge part of the populations of East and South Asia. They've done very well, and the very rich have done very well. And a lot of people have not done very well, and they're very much the middle-income people of the developed world. Politically, that's the most important group. These are the people who elected Donald Trump and voted for Brexit, and are so unhappy in Europe today that we don't know what will happen in the European elections. That's very important. The third secular trend, as I said, is productivity. This is, I think, a very remarkable chart. I don't have the very last few years, but it wouldn't have changed the picture. This comes from Robert Gordon's extraordinarily important work on the American economic story. The American economic story is essentially the growth story of the frontier of the world economy for about 140 years. The core innovations that drove the world economy were either in the US alone or in the US along with a very small number of other economies, particularly Germany in the earlier periods. So this is the frontier of the world economy. What is Robert telling us? He's telling us that the great growth miracle in terms of total factor productivity, which is a measure of innovation, the rate of innovation in the world economy, was between 1920 and 1970. We have not replicated that since. There was a blip upwards between 94 and 2004, which is the internet revolution, and between 2004 and 14, total factor productivity growth, a measure of the rate of innovation in the economy, the rate at which we improve our efficiency, has been exceptionally slow. Is that mismeasurement? Yes, in part, but we've always underestimated TFP. That's quite clear. So it's not clear that the mismeasurement begins to explain this. And that's another reason people in the developed country are miserable, that the basic underlying innovation dynamic seems to have slowed. And the final secular trend I would mention, without going into detail, is all the evidence we have so far. You can see this shows estimated global greenhouse gas emissions. I'm one of the people who believe that climate change is a very, very substantial threat. Under current policy, and we see no sign that it's really going to break, the pledges are not probably going to be delivered upon, we are going to have very, very sizable climate disruption in the middle part of this century, and it could be on a very, very large scale. Now I'm going to deal with the second major theme that I was going to discuss, crisis and its aftermath. And I want to cover very, very briefly some of the extraordinary features of the world we live in, because it bears on the extent to which the next 10, 15, 20 years will be reasonably stable. And there are the following things. The first, I'm going to talk about how often crises happen and what drives them. I'm going to talk about the global savings glut. I'm going to talk about debt overhangs. I'm going to talk about our extraordinary and unique monetary environment. I'm going to talk about real income stagnation, China's rebalancing, and globalization. These are where we are now, what's going on now. So the first chart is just to anchor you in the idea of what, as far as we know, causes big disruptions in the world economy of the type we have experienced. So in this chart basically shows global economic growth. It's the world's growth annually since 1900, and the best figures we have, which are based on the work of the late Angus Madison. And the little roundels refer to the right-hand side to major world recessions, major world downturns. What triggered them? There are 2 points that I think are very important. One point which is very important to note before we go anywhere else, which is since the Second World War, the world has avoided any recessions. That is to say, there's never been a year in which the whole world economy's real growth was negative. And that supports the proposition that far and away the single most important assumption about any year in the world economy is the world economy will grow. And probably on average, I'm going to come to this later, about 3% a year. Your starting point should be the world economy will grow about 3% a year in real terms, and in that purchasing power parity, international dollars, which is what the IMF uses, or about 2.5% at market prices. And the second point is we have managed to avoid major world recessions since the Second World War, not before the First World War, before the Second World War, because we've avoided true global catastrophes like world wars and Great Depressions. So the only qualifier I would make to what I said is the world economy will grow as long as we avoid true catastrophes. And the catastrophes, the major catastrophes, are very clear from the experience. They're world wars or gigantic depressions. If we look at the post-war period, it's clear that the major slowdowns we have are basically big financial crises, the Asian financial crisis or the global financial crisis, which is Roundel 8, or oil price shocks, which coincide with wars, unfortunately, in this region. Otherwise, not only does the world economy grow at 3%, but it grows very close to 3%. So you have to ask yourself, can we avoid another financial crisis? Can we avoid war? Wars in sensitive regions or wars between great powers. Provided we can avoid these things, we're fine. Do I predict things like that? No. The second thing I wanted to talk about is brought out very, very clearly in this chart, which in a way I think is among the most important and least understood phenomena of in the global economy, and it's the background for everything else. I plan to write my next column about it. This shows what's happened to global real interest rates, the real return on safe assets since the early 90s. This is from UK index-linked gilts. If I put US Treasury index-linked securities tips in as well, they would coincide pretty well, but they don't go as far back as that. The basic point, I won't be able to go through in detail why, is that real interest rates were close to 4% before the Asian financial crisis, and they've been 0 to negative now for most of the last 10 years. We are living in a 0 to real interest rate world. A structurally real interest rate zero world. Why is that? The only plausible assumption is that we have a very large surplus across the world in desired savings relative to investment opportunities in large-scale capital creation. And the reasons for that are profound and significant, but I don't have time to go into them except to say there's no reason to expect that to change soon. I've been making these speeches now for 10 years. I go to asset managers, I go to insurance companies, say, surely interest rates will go to rise at some point soon in real and nominal terms, and my answer is no evidence that they will. No evidence that they will. And what this means, of course, is if you want decent returns, you have to take a lot of risk. That's what it means. Safe returns are 0. I won't get into the question of whether they're really safe. They could be less than 0, but they're not higher. One of the reasons for the incredibly low returns since 2009, of course, is we have a massive debt overhang. In the run-up to the crisis is the debt of mature economies, percent of GDP. We had a massive debt run-up up to the crisis. I think that's the way we dealt with the savings glut. That was the theme of my last book, The Shifts and the Shocks. I don't have the time to go through the argument. Anyway, the debt mountain reached a peak in 2008, broadly speaking, and since then it's stabilized. Its structure has shifted from the financial sector and to the household sector to the government sector, which is at the top, but the amount of debt relative to GDP is the same. The whole strategy of the post-crisis period is debt management. And how do you manage debt? You keep interest rates very low. And since there's just as much debt as there was now as there was then, they're going to go on keeping interest rates low as long as they can. What could stop that? A massive outbreak of inflation. What happens with a massive outbreak of inflation? Armageddon. I mean that, Armageddon. It means mass defaults. No financial institutions will be safe, because that's what the authorities of the Western world decided to prevent. And the only way they can do that is keep interest rates very low. And just to indicate how low they've kept them, this is just about my all-time favorite chart. I've already given you two or three of my favorite ones, but this is pretty well my all-time favorite chart, just how phenomenal the world we have is. So this is, don't pay too much attention to those 94s. That 94 in the left-hand side isn't 1994 or 1894, it's 1694. So the Bank of England, God bless it, has been around since 1694. I think that's the first year. It's the second oldest central bank in the world. Some think it's really the first. I won't go into the debate about which is the first. And the Bank of England has been lending to banks, unsecured so overnight lending, providing liquidity to banks ever since 1694. And these were the rates of interest at which it was doing that since 1694. And what you will notice is that until 2009, it was never below 2%. Never. There were two world wars. There was a Napoleonic War. There was the Great Depression. But it was never below 2%. It's been near zero for 10 years. There's a tiny up blip at the end, which I haven't shown, but essentially it's been zero for 10 years. And so it has been for all the other major central banks of the world. So the way we dealt with the debt overhang and the massive crisis in the savings world was to provide free money. Has free money generated inflation? No. Every government in the world, in the major countries, is worried that they can't get inflation up. Is that normal? Of course it's not normal. No economist would have believed that was possible, that you could have 10 years of free money from the developed country's central bank, enormous expansions of the balance sheet, and absolutely no inflation. There is no country which is well above its target. The third thing, the next thing that I want to discuss is just to underline the income distribution point I made earlier, which is what's been going on in the politics of the developed countries. There are so many things going on there, but let me just focus on this. It's a very nice, illuminating chart. I don't have later data, but the picture hasn't changed much. This shows the proportion of households with flat or falling real incomes from wages and capital in the developed world, a whole slew of developed countries between 2005 and 14. And the basic point, look at the weighted average for 25 advanced countries, look at the countries on the left-hand side. Most people in these countries are experiencing stagnant or falling real incomes. In Italy, it's 97% of the population. In others, it varies about 80% or two-thirds. This isn't the deal. The citizens of developed countries are used to the idea they should get richer every year, a little bit, and they're not, and they don't like it. And they're losing the nice jobs they had, and there's lots of social upheaval. There are lots of foreigners around, and they don't like that either. And they are voting on that basis. So that's crucial. Now, I wanted to talk a little bit about how the global financial crisis affected China and its problems today in managing its economy. So this is a couple of very simple things about China. There's so much that's fascinating and obviously so much I don't understand, but this is the core of it. This shows the structure of China's demand. It's the breakdown in demand between household consumption at the bottom, government consumption, investment, and net exports. It's how it consumes its GDP, as it were. Back in 2000, China had a nicely balanced economy. Consumption was about 64% of GDP. Investment was about 35% of GDP, very reasonable for a country growing at 10% a year. And the net exports were 10% of GDP. By 2008, consumption had collapsed to about 50% of GDP, the lowest in any major economy in history as far as I can see. The net exports were 10% of GDP, an enormous current account and trade surplus, and investment had got up to about 40% of GDP, a little under 40% of GDP, incredibly fast, but at least consistent with the fast growth of this economy. And then came the crisis. What did the Chinese authorities have to do in the crisis? They had to accept a complete disappearance of that enormous current account surplus. And the current account surplus did indeed disappear. To sustain growth in the economy, they had to replace that with another source of demand. What did they replace it with? Investment, debt-fueled investment, and investment reached very close to 50% of GDP. Investment reached 50% of GDP, inconceivably high level. But this is a country where savings are half of GDP, so they have to go into investment or the current account surplus. This happened at the same time as underlying trend growth in the Chinese economy fell from 10 or 11% to about 6, something lower. It's almost halved. So you increase investment massively and you reduce growth massively. What's happening? The return on investment is collapsing. It has to be. And not surprisingly, to make that happen, China had to do what we'd done before the crisis, create an awful lot of bad debt. And that's what's happened here. That is what this chart shows, mostly in the non-financial corporate sector. The Chinese authorities know this is happening. They want to stop this. Unfortunately, if they stop this, there's a real risk that investment will stop growing. And if investment stops growing, since it's half of GDP, GDP stops growing. They're in recession. Consumption alone isn't big enough to drive it. It's not like the US or UK, a consumption-driven economy. And this is the Chinese dilemma. And then comes along Mr. Trump and starts trying to smash their exports. He doesn't smash their exports, but he smashes confidence and therefore investment in the private sector. The last thing I wanted to talk about, I think it's the last thing, is deglobalization before I move to the prospects. The other really big thing that happened into the crisis is that after the crisis is the globalization dynamic slowed. This chart shows the blue columns are annual growth in world trade. The light blue columns are annual growth in real GDP. The black and the red lines are the moving average of those things. 5-year moving averages. The red is trade. The black is GDP. And the simple story is up to the crisis, trade was growing twice as fast as world GDP. And since then, it's been growing at the same rate. So we have ceased to globalize. We have not deglobalized. There's lots of other measures that indicate some serious deglobalization, but the great underlying trade globalization story is definitively over, and it's been over since 2008. So let me, with those remarks, move finally to our future, and I will emphasize these 5 points about our future, things we know about, things we don't know about, and things we can worry about. Demography, growth, interest rates, the globalization story, and geopolitics. So the first point, which this is something we do know about the future, which is where the people are going to grow. For your interest, by the way, for this purpose, this region is in Asia. Essentially, the story is very, very simple. All the increase in the population of the world up to 2050 on plausible assumptions will be in Africa, which generate 56% of it, and Asia, which will generate 35%. These are the regions of young people, growing populations, the demand for jobs, and if jobs aren't there, in the case of Africa, the demand to leave. The demand to go somewhere else. In the African case, probably Europe. European population is shrinking. So that's the first thing we know, and I think it's the most obvious shaper of many of the stresses, political and economic, we have. The second thing we know, well, here's a closer to a guess. I said this is one source. It's actually from Capital Economics, but it's very useful. This shows global growth starting in the 50s and up to 2037. The basic point is the fastest growth period was immediately after the Second World War, the years of recovery. We had very buoyant growth in the world economy between 74 and 2017, mainly driven by this convergence catch-up story I've told you. The likelihood is, and I think it's a very plausible guess, that over the next 20 years or so, the world economy will grow at 3% a year, and the fastest growth will continue to be in Asia. Now, there is a very interesting debate going on now about where that growth will be in Asia. And this I put up simply because it's a most extreme forecast. I'm not saying it's going to be true. I don't know. Nobody knows. These are the shares of the world economy at purchasing power parity. And this particular set of forecasts argue that China's share might shrink a little even. I think that's implausible. I think it will probably continue to rise significantly. But the big rise in this picture, and that seems to me very plausible, unless things go very badly wrong, is in India. The US share will probably be stable. That's at the top. The European share is clearly going to fall. There's no doubt about that. The big implication of this is that even with this very depressed forecast for China, by the middle of the 2040 or so, Asia will be as big as the developed countries as a whole. And given their demographics, their population, that it seems to me is bound to continue. We are going to be in a world, inevitably, since this is half of the world's population, by 2050, unless something goes very badly wrong, in which East and South Asia are the world's economic center. US will probably be the richest. It will continue to be very important, very powerful, but the likelihood is it will shrink, and the other developed countries, given their demographics, will shrink more quickly. A crucial question for many asset managers is the future of interest rates, and I've touched upon this now. So this is 10-year bond yields going back to 1990. You can see the general trend has been down. The other thing you can see is the clear evidence of the convergence of almost everybody until very recently on the Japanese experience. We've all become somewhat Japanese. Why? Because we all suffer from this ultimate problem of its debt overhangs, very weak demand for investment, savings surpluses. It's clear in Europe, and it gives us these very low interest rates. The US has recently seen rising long-term yields, very modest. They're still well below 4%. And given what the Fed has just decided, it can't even raise rates above the very low level at the moment. They are likely to stay so low. As long as we avoid inflation, the likelihood is yields will remain very, very low. The third thing about the future is how complete will be the breakdown of the trading system. There are many things I could have gone through on this issue, and I can't go into detail, but the basic point is the US has introduced already a very significant number of measures attacking its imports, and these have consistently led to retaliation from its major trading partners, from China and the EU. It is possible, but by no means certain, that the US and China will reach a trade deal. I'm very far from convinced that it will on the US terms or anything like it. I think Donald Trump will have to blink to actually get a deal. But even if it does, the likelihood is it won't stick, and more importantly, will be immediately followed by attack on Europe. We know that. They've said so. So the trade war problem, as long as the US continues to feel global trade is a racket, is not over. It is not over. And it's not just Donald Trump. Lots of people in America agree with this, including, interestingly, the Democratic Party. The only thing they agree on is that trade is a racket. They really do agree with Mr. Trump on this. And then, of course, there's geopolitics. So this is a chart I used in one of my columns that shows the competition between the US and China strategically as against the competition with the Soviet Union in the late 80s. And the key points here are China is still a much smaller military threat, quote unquote. It spends much less relative to the US than the USSR did, say, in the 1980s. You can see that in the fourth set of columns down. But its population is vastly bigger, which we know. Its GDP per head is still vastly relatively lower, and it's got much higher exports. In other words, China's potential is much bigger than the Soviet Union's was, and that brings back to whether it can solve its problems. And it's completely intertwined with the world economy and the US. So that any quote-unquote Cold War between the US and China will be much more difficult to handle because China is much bigger in potential, much more intertwined with the world economy. And disentangling it, as some in America want, is, I think, virtually impossible. So let me just bring together what I've tried to say. I know it's a lot. It's a complicated world. We're living through a transformative period for the world economy and the world system. A massive shift in global power, erosion of the liberal international order from its core in the US, erosion of the West as a system with the increased friction within the transatlantic alliance, the rise of populism, slowing underlying growth, particularly shown in productivity growth slowdown, incredibly low nominal and real interest rates, and a huge debt overhang can only be stabilized as long as interest rates remain low. And the conclusion of this is then there is going to be growth, but it is a fragile world and quite big shocks can happen, which brings back to my point earlier. What could those shocks be? Geopolitical shocks between the superpowers and major renewed financial crises. Could the latter happen? Yes, for a simple reason. There's just so much debt out there, and it hasn't gone away. Thank you for listening.